Two investors, 60 lakh portfolio, same market correction. But investor A loses 18 lakhs in 3 months, while investor B loses only 10 lakhs. Same starting amount and same market volatility, but an 8 lakh difference in portfolio pain. And that difference affects not just returns, but peace of mind too. What did investor B know that investor A didn't? Investor A thought diversification meant owning multiple mutual funds from different fund houses. But investor B knew a simple framework for asset allocation for portfolio diversification that made his portfolio more resilient during market drawdowns. He knew the critical concept of correlation and role-based asset allocation. In this video, we'll discuss first, what does portfolio diversification even mean? Second, a simple framework for portfolio diversification. And third, we'll see investor A and investor B's example to understand the framework. This video is only for educational purposes to help you evaluate your own asset allocation. Okay, here's what many investors consider as diversification. 5 different equity funds, different fund managers by different fund houses. But let me share a concept that might change how you think about diversification. Let's understand correlation. Correlation simply tells us whether two assets move together or not. The scale runs from -1 to +1. Just one number can help you understand if your portfolio is truly diversified or not. +1 is positive correlation. That means assets tend to move in the same direction. 0 is neutral correlation. That means there's little to no relationship between two assets in the portfolio. And -1 is negative correlation, which means assets tend to move in the opposite directions. Let's come back to the portfolio of 5 equity funds. What do you think would be the correlation of these? It would be a high positive correlation of 0.95 plus. That means these funds tend to move almost identically in the same direction. So even with 5 different fund names, your portfolio may still be exposed to the same underlying risk. This can also be called as diversification. More funds but without meaningful diversification benefit. The purpose of diversification is to make the portfolio more resilient to market volatility. Diversification then can help you stay invested during market corrections and have stable assets that can manage the overall portfolio volatility. We can understand this in detail through correlation numbers. Nifty 500 index correlation with other equity funds is a very high positive correlation of around 0.95. That means other equity funds typically move similar to Nifty 500. Debt instruments have almost zero correlation. That means they are relatively neutral to volatility in equity. Gold or commodities have a correlation of negative 0.35 with equity, that is Nifty 500 in our example. Gold has historically shown a tendency to move in the opposite direction of equity. This difference in correlation patterns is why diversification can help reduce overall volatility in your portfolio. This Google sheet can help you understand how correlation behaves between different asset classes. I've calculated correlation based on yearly returns. Link is in the pinned comments. Do check that out. Okay, so the first part of portfolio allocation is understanding the role of correlation. But an even more important part is having a role for every asset in your portfolio. This is where investor B differed from investor A. He didn't just look at funds. He assigned a role to every asset in his portfolio. I want to share a framework that I use to think about portfolio allocation. I've abbreviated it as GSS so that it becomes easy to remember. Every asset class can be evaluated through 3 roles for a portfolio. G is for growth engine, S is for stabilization, and the second S is for shock absorber. Starting with G, the growth engine. True to its name, these are growth assets meant for long-term compounding and wealth creation. The assets that might fit here are domestic equity funds like large cap, mid cap, or flexi cap indices, and global equity exposure like international funds or US index funds. Let's combine our understanding of correlation to reduce overall portfolio volatility. Suppose in your existing equity fund, if you add another similar domestic equity fund, the correlation might be a very high positive of 0.95, which we saw earlier. But if you add global equity exposure, the correlation with Indian equity is typically around 0.6 to 0.7. This can help improve diversification. The principle is if you want diversification within growth assets, you can also consider different geographies or market segments, not just different fund names in the same geography. But please keep in mind that equity allocation should be based on every individual's unique risk profile, financial responsibilities, and their goals. Coming to the stabilizer bucket. True to its name, assets in this bucket usually have low to near zero correlation with equity. That means whenever equity moves up or down, this bucket's returns will not really be affected. Hence, these will stabilize the overall portfolio. Some examples of asset classes for this bucket are debt funds, fixed deposits, bonds, PPF, EPF. Debt is not meant to be exciting. That's usually the point. Lower volatility assets can help you stay invested during turbulent market periods. So, investors could include the stabilizer bucket in their portfolio for either of these three reasons. First is liquidity buffer for meeting their financial needs without selling volatile assets when they are already down. Second is volatility reduction so that overall portfolio experiences less dramatic swings. And third is rebalancing opportunity so that there is flexibility to shift allocation from stabilizer to growth assets at the right opportunity, maybe during market dips. That brings us to the last S of shock absorber. Its role isn't to give consistent returns, but to help the portfolio behave differently when equity markets are under stress. The assets that might fit here are commodity ETFs like gold or silver. Commodities have a historical correlation with equity of approximately negative 0.35. That means commodities have historically moved in the opposite direction of equity. So it could act as a shock absorber during periods of equity drawdown. One caveat is that this negative correlation is a long-term historical average and not a guarantee. In certain periods, gold can move with equity, and in some other periods, it might not provide protection when equity corrects. However, the most important principle is that shock absorber assets work best when accumulated before market stress, not when everyone starts realizing the need for protection. If you want to understand your current allocation and where you aspire to be, you can use the Google Sheet to enter your percentage allocation in the growth, stabilizer, and shock absorber buckets as per your financial goals. It's the same link which is in the pinned comments. Let me share a hypothetical comparison to illustrate the entire GSS concept. Let's take the example of investor A who has a single asset class. 60 lakhs across multiple equity mutual funds which have high internal correlation of around 0.95. Hypothetically, if markets fall 25 to 30% over 3 months, the entire portfolio would likely fall in the same direction. So potential drawdown could be around 30%, approximately 18 lakhs. Now, investor B, who did a role-based allocation, had the same corpus amount of 60 lakhs across different buckets. Let's see how his portfolio behaves in this case. Suppose investor B allocates 60% to growth engine, that would be around 36 lakhs, 25% to stabilizer, that would be around 15 lakhs, and the last 15% to shock absorber, that would be around 9 lakhs. Hypothetically, if the market corrects by 25 to 30% over 3 months, growth engine bucket might fall by 30%, around 11 lakhs. The debt portion would remain relatively stable. Gold might rise modestly, giving a gain of 10%, so around 1 lakh. Potential drawdown for investor B would be 16.5% of his portfolio compared to 30% drawdown of investor A. The key insight isn't the exact numbers. It's how role-based assets with different correlations reduce portfolio volatility. You can tweak the numbers in the Google Sheet that I've shared as per your financial goals. Let me summarize what we've covered today. First, diversification isn't about having mutual funds from different fund houses. It's about understanding correlation and role based asset allocation. The goal of thoughtful asset allocation is to build a more resilient portfolio that helps you stay invested during market volatility and through different market conditions. Second, the GSS framework can be a thinking tool for role based allocation. Growth engine is for wealth creation, stabilizer is for capital preservation, and shock absorber is for diversification from equity volatility. Markets will experience volatility, that's a given. The difference between investor A and investor B wasn't luck or market timing, it was understanding the difference between diversification and genuine diversification. Everything shared today is educational content about portfolio diversification. This is not personalized investment advice. Your optimal asset allocation depends on many personal factors like your risk appetite, your time horizon, your financial goals, tax situation. So it is best to consult a financial advisor who understands your unique situation before making any big investment decisions. If you found this framework useful, share it with someone who might benefit from having a different perspective about their portfolio. And do let me know your thoughts in the comments. If you want more actionable investing insights and frameworks, then do subscribe to the channel and to my free weekly newsletter. Thank you for watching. See you in the next one.